Bloomberg Audio Studios.
Podcasts, radio, news.
Shares of Wells Fargo are down about 1%. The bank reporting a revenue beat and a net interest income miss. Now, this is the struggle. We heard this from JP Morgan also. Muted loan growth and increased pressure to pay out more for deposits. All of that eats into profits. Well, joining us now for more is the CFO of Wells Fargo, Mike Santomassimo. Joins us now. Thank you so much, Mike. It's really good to chat with you. We always appreciate you coming in every earnings day around this time. Let's talk about deposits for a moment. How much do you think you're going to have to increase those deposit rates to keep the deposits that you still have?
Well, first, thanks again for having me. I think what we're seeing in the quarter with net interest income and deposits is exactly what we thought we would see, for the most part. And I think when you look at overall sort of levels, they came in slightly better than we thought. Loan growth is slightly less. That's offsetting some of that. But what we're seeing, in the book, both on the consumer and the commercial side, is exactly what we expected. On the commercial side, we're not. Those deposits have been competitive from a pricing perspective now for a while, and that'll stay the case as we look forward. On the consumer side, what we're seeing really is people spend money that's in their checking accounts, and in some cases reallocate money to CDs or savings vehicles, and that's what's causing sort of the increase in interest expense, on the consumer side. But overall, it's exactly kind of what we thought would be happening as we came into the quarter.
But Romaine and I were just talking about this before the show. That was so interesting to both of us, that non-interest bearing deposits fell 18% in the quarter compared to the same period a year ago. You guys still have non-interest bearing deposits?
Yeah, no, look, I think, when you look at kind of core, operating accounts, checking accounts, that's what makes up the bulk of that. Plus, some commercial deposits sort of fall into that category. But the decline you've seen has just been a natural progression throughout the year as people spend down. And the biggest driver really continues to be consumer spending and some reallocation into CDs and other products.
So what do we talk about, Mike, when you look forward into the year? I know on the conference call, you guys talked a little bit about new credit cards and some other products here. The idea that there is something coming down the pipeline that maybe can sort of help boost growth here. What are you hoping for?
Yeah, well, I think you have to look at the revenue line in total when you sort of think about that. And I think, in the quarters, I think a good example, we had really good fee growth, across most products and most businesses. And when you look across the year, hopefully we'll continue to see some good benefit from those investments we've been making that's been driving some of that growth as well. And on net interest income, it's going to be a function of what we continue to see with rates, what we continue to see with how clients behave with deposits and how much they reallocate to other products, how much they spend, how much loan growth we see from both the consumer and the commercial side. So there's a lot of variables that sort of go into it. But as we said on the call, we feel better about where we are today than we did in January. But I think there's a lot to play out through the rest of the year, and we'll see how things progress.
But I do want to kind of stay on credit cards because on one hand, that did appear to be a bright spot. You had decent growth. I think it was something like 6%. Correct me if I'm wrong. But that came because of higher loan balances, which of course would raise the question about the ability, the capacity of those folks to repay that. What's the balance looking like right now?
Well, Romaine, a lot of the growth we're seeing in the credit card business is a function of what we've been doing and investing in over the last 3 years. So we've launched a whole bunch of new products in the last 2.5 years. Those are getting really good traction from both our existing customers and new customers, and that's what's driving a lot of the growth there. Not necessarily just existing customers growing their balances higher. Some of that's happening as well. And as you would expect, there's some customers that need to do that to continue to, deal with all the things they need to deal with in their life. But what we're seeing there is just some natural progression of charge-offs, natural deterioration in that portfolio that you would expect coming off really the historic lows that we saw during COVID. So, and everything is really performing as we thought it would at this point when you look at all the different products, the vintages, the different types of customers. So we're not seeing anything that would fall outside of what we would have thought in our expectations.
What about growth, say, internally with investment banking and trading as well? Like, when does the asset cap kind of get put to the side and you can really make the investments that you want to be making in there? What does growth look like?
Well, again, we've been investing in those businesses too now for the last number of years, and I think you saw some of the benefit of those investments coming through in the quarter. On the investment banking side, we participated in what was a pretty strong fee quarter for the industry. You saw that in investment grade debt capital markets. That's a business we've been very good in for a very long time. We saw some higher advisory fees, off the back of some of the investments we've been making with people and in relationships there. So that's good, and I think that'll continue to play out over time, as assuming the market cooperates with us. And on the trading side, it's similar. We've been investing in technology, people, and you're continuing to see that. But that is definitely a business. The trading business is definitely a business where it's been more constrained by the size of the balance sheet over the last few years. And as we have more flexibility, we'll be able to deploy more resources there over time.
Right. So flexibility, aka regulatory work that you guys have to do. You guys inherited a lot of stuff. The baseball analogy, what inning are you in? The ninth inning, sort of like you're done, you're off to the races.
Well, I think as I've said, on this, in this forum a number of times, we're continuing to make that finishing that regulatory work is our top priority. We're going to continue to do that, focus on it with everything we've got to get through it. You saw, one of our consent orders related to sales practices terminated in the first quarter, so I think that's a good sign. For all the work that we've been doing. We're thankful for all the effort people put in for that. And so we're going to continue to stay focused on it, and we're not going to stop until we're done with all of it.
All right, Mike, really appreciate you taking time for us as always. Mike Santomassimo, he's the CFO over at Wells Fargo.